What happens when your biggest ally becomes your biggest creditor and then threatens to pull the plug? Japan just fired the quietest warning shot that could crash the US economy, and barely anyone noticed. They've started selling off America's debt. $21 billion dollars in treasuries gone in 2 weeks. The biggest dump since records began. Why? Because Tokyo's drowning in the worst fiscal crisis since World War II. And now, Japan is threatening to unleash the nuclear option, liquidating its $1.13 trillion US bond stockpile. If they do, interest rates will explode, Wall Street will buckle, and the dollar itself could go into free fall. This isn't a headline, it's a countdown. America's biggest financial lifeline just became its biggest threat. Japan, the largest foreign holder of U.S. treasuries at $1.13 trillion, has quietly hinted it might dump a portion of that debt. Finance Minister Katsunobu Kato told Fortune on May 7, 2025, that all cards are on the table amid escalating trade tensions with Washington. This wasn't abstract. In April alone, Japanese institutions sold over $21 billion in long-term foreign bonds, according to Bloomberg, with analysts confirming that much of it likely came from U.S. assets. Markets noticed. Treasury yields spiked. The yen surged past 140 to the dollar. And in the span of 2 weeks, Japan turned from ally to possible bond market disruptor. But is this posturing or preparation for financial war? Because what happens next won't just hit investors. It could raise U.S. mortgage rates, choke consumer credit, and destabilize the global safe asset used by central banks worldwide. And that's only the beginning. Japan's national debt just crossed 1.28 quadrillion yen, over 234.9% of GDP, the highest among developed economies per the IMF. Interest rates that hovered near zero for decades are now climbing fast. Its 30-year bond yield breached 3.2% this month, a historic peak. That spells disaster for a country addicted to cheap borrowing. Making things worse, Prime Minister Shigeru Ishiba's 2025 budget soared to a record 115.5 trillion yen, about 730 billion, with 38 trillion yen, or one-third, allocated to Social Security alone. Aging demographics mean more pensions, more health care, fewer taxpayers, and no room for economic maneuvering. But the real pressure point: the U.S. isn't throwing a lifeline, it's throwing tariffs. Trump's 25% import duty on Japanese autos, steel and electronics, paused but not canceled squeezes Japan's export economy at its weakest point. And now, Washington expects Japan to keep buying treasuries while it's bleeding cash. The contradiction is fueling a slow shift from dependency to defiance. Since 1998, Japan has run an uninterrupted primary fiscal deficit, now averaging 5% of GDP, according to the Ministry of Finance. Strip out Social Security costs, and the budget might balance. But with the elderly set to make up nearly 40% of the population by 2045, those costs aren't going anywhere. Japan's fiscal policy is boxed in. It can't print money without risking inflation, can't raise taxes without crushing demand, and can't cut spending without triggering a social crisis. Meanwhile, U.S. tariffs undercut export revenues just as Japan's bond auctions start to weaken. Yields for 20 and 30-year paper are near multi-decade highs, and that cornered feeling is turning strategic. If Japan can't borrow more cheaply, it may choose to reduce exposure by selling U.S. treasuries, not rolling them over. It's a move that risks retaliation, but the alternative may be economic suffocation. Let's freeze. Because this isn't just a Japan problem anymore. In the first quarter of 2025, Japan's GDP shrank by 0.7%, following 3 negative quarters in 2023. Exports declined 0.6%, while imports rose 2.9%, worsening the trade imbalance. Private consumption flatlined, and household real income dropped 2.1% year over year, according to the Bank of Japan. These aren't abstract figures. This is a G7 nation sliding into a structural recession, just as Trump's tariffs reignite. According to Reuters, the baseline 10% U.S. tariff and sector-specific duties remain active, throttling Japan's already eroding competitiveness. Meanwhile, China, the primary competitor, keeps flooding markets with cheaper alternatives. But the scariest part isn't the slump. It's the leverage Japan holds over the U.S. bond market. If Tokyo uses that financial weapon at the wrong moment, America's risk-free asset could suddenly look very risky. And once that trust is broken, it doesn't come back quickly. In 1985, under intense U.S. pressure, Japan signed the Plaza Accord, agreeing to appreciate the yen to address trade imbalances. Within 2 years, the yen doubled in value, Japanese exports collapsed, and asset bubbles formed, eventually triggering Japan's lost decade. Fast forward to today, and Finance Minister Kato is being pushed by Washington again to allow the yen to strengthen this time to offset U.S. tariff pain. But Tokyo isn't eager to repeat history. BOJ officials warn that further appreciation would cripple exports just as bond markets begin rejecting long-duration debt. The fear is grounded. Last month's 40-year bond auction saw the lowest demand in 8 years per Nikkei Asia. So now, Japan stands firm. No Plaza 2.0, no currency capitulation. But if that stance triggers a U.S. backlash or another round of tariff hikes, the crisis could metastasize fast. And Japan's $1.1 trillion card, it's still in its hand waiting. This isn't a theoretical threat. Japan is already dumping U.S. debt. In just 2 weeks, between April 12th and April 26th, Japanese institutions offloaded more than $21.1 billion in long-term foreign bonds, marking the largest 2-week bond outflow since tracking began in 2005, according to Bloomberg and Japan's Ministry of Finance. Analysts at Nomura and J.P. Morgan estimate the majority of these liquidations were U.S. Treasuries and agency-backed mortgage securities. The yen simultaneously surged past 139.8 per dollar, its strongest level this year, suggesting Tokyo is using bond sales to absorb upward pressure on its currency while countering Washington's calls for artificial appreciation. Finance Minister Katsunobu Kato didn't deny the tactics, stating, "Our Treasury holdings ensure liquidity for market operations, but refuse to rule out their use as a trade lever." The message is clear. Tokyo isn't bluffing, and Wall Street knows it. If Japan accelerates its Treasury sell-off, the impact on U.S. credit markets could be immediate and severe. Goldman Sachs warned in its May 2025 fixed income outlook that an abrupt liquidation of just 10% of Japan's holdings, roughly $110 billion, could raise the U.S. 10-year yield by 40 to 50 basis points. That would hit everything from mortgage rates to auto loans, as nearly all major U.S. credit markets are priced off Treasury benchmarks. As of May 17th, U.S. 30-year mortgage rates already climbed to 7.21%, up from 6.74% just 4 weeks prior, according to Freddie Mac. The Treasury Department faces a bind. Rising yields threaten domestic lending and debt service costs. But trying to stabilize rates with more issuance invites inflationary pressure and crowding out. Japan's nuclear option may never be fully deployed, but the tremors from just hitting at it are already visible in U.S. bond volatility indexes, which spiked 18% this month alone. And the real weapon here, uncertainty. The yen carry trade, a strategy where investors borrow cheaply in yen to buy higher-yielding U.S. assets, is collapsing. Japan's own 30-year bonds now yield 3.15%, while the U.S. 30-year hovers around 4.38%, shrinking the once attractive interest rate spread to its lowest since 2011. Meanwhile, the dollars slide down 3.6% in Q2 so far, per the DXY index, makes holding U.S. assets less attractive to Japanese investors already reeling from FX losses. BlackRock noted in its May 2025 fund flow report that Japanese pension funds are shifting allocations back to domestic bonds for the first time in 5 years, citing both rising domestic yields and geopolitical unpredictability in Washington. As U.S. investors face the prospect of higher yields but declining foreign demand, the realignment could spark a longer-term rebalancing away from dollar-dominant portfolios. What started as a tactical move by Tokyo is turning into a structural shift, and America's funding machine may soon feel the shortage. On May 28th, all eyes turned to the G7 Finance Ministers Summit in Banff, where Japan's Finance Minister Katsunobu Kato and U.S. Treasury Secretary Scott Bessent will meet for a closed-door session framed as a discussion on exchange rate stability. But the stakes are far higher. According to internal memos leaked to Nikki Bessent, is expected to push for a measured appreciation of the yen, reviving echoes of the 1985 Plaza Accord, a move Japanese officials see as economic suicide. In contrast, Kato plans to propose a dual-track compromise. Tokyo will halt further Treasury sales if Washington lifts its 10% baseline tariff and suspends pending auto duties. Neither side is expected to bend easily. The U.S. sees yen appreciation as a political necessity. Japan sees it as a path back to the lost decade, and if talks collapse, Bessent's next statement may trigger a bond sell-off not from Beijing this time, but from Tokyo. So the trillion-dollar question remains: will Japan actually dump its Treasury holdings, or simply dangle the threat until Washington blinks first? In this high-stakes standoff, both economies are vulnerable. For the U.S., foreign bond demand is the spine of its fiscal architecture. For Japan, exports are its last reliable growth engine. But if neither side yields a policy misstep, intentional or accidental, could unravel a 40-year alliance and fracture the very foundation of global credit markets. So let's put it to you. If Japan sells even a fraction of that $1.1 trillion, who absorbs the shock, drop your thoughts in the comments, because this isn't over, not by a long shot. And what happens next at the G7 might rewrite the next chapter of the U.S. economy. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.